The debate over active and passive investing isn't anything new. Passive strategies are often praised for their low fees, simplicity, and long-term performance. Active strategies, on the other hand, can often offer greater flexibility, adaptability, and tools to manage risk. There's not really any one-size-fits-all answer. Both approaches can work really well, depending on your goals, time horizon, and tolerance for risk. In fact, a blended approach can often be the right answer for many people. But one area that may be overlooked when considering active or passive investing is what happens when you actually start taking money out of your portfolio, not just growing it. That shift from accumulation to decumulation can change the dynamic, and it's where active investing may at times offer some differences that aren't always obvious in headline performance numbers. But what is active and passive investing? Well, passive investing is about tracking the market. It's often low cost, broadly diversified, and great for long-term, higher risk, hands-off growth. Active investing is a bit more involved. Managers select assets with the aim of managing volatility, seizing opportunity, or adjusting to market changes in real time. Yes, the fees are typically higher, and no, outperformance definitely isn't guaranteed. But once you start taking monthly income, things can get a bit more nuanced. You're no longer just riding out the markets. Instead, you might need to sell assets regularly, regardless of whether it's a good time to do it or not. That can create three big problems. Cash flow pressure, so you might even need income when markets are falling. Sequence of return risk, so bad market years early on can compound losses. Volatility damage, so selling in a drawdown can lock in losses and erode capital faster. Now, active investing might be able to help here by managing some of these risks. Managers can dial exposure up or down, raise cash, or introduce defensive assets. That flexibility can help protect your portfolio and may help reduce some of those things. So we put two Soltis portfolios to the test, one active, one passive. Both started with £1 million, and they had monthly withdrawals of just over £4,100, so a 5% annual income. Both are medium risk portfolios, and the period we looked at was from the end of 2016 to the end of May 2025, so almost 8.5 years, so a decent period. Now, the active portfolio here is our Soltis multi-asset class and private asset strategy. It's managed by our investment team and includes a mix of equities, bonds and alternatives with the goal of improving risk-adjusted returns over time. The passive portfolio is Soltis Global Markets. It follows a more traditional buy and hold approach. It's mostly equities and bonds built for long-term growth without regular tactical adjustments. Now, in terms of total return, the passive portfolio came out slightly ahead, 57.1% compared to 56.3% for the active. So looking at those figures, which investment strategy would you choose? Well, at first glance, passive may look like the winner. But once you factor in those monthly withdrawals, the picture changes. By the end of the period, the active portfolio had more money left. It finished with just over £1,040,000, whereas the passive portfolio ended at around £1,036,000. So despite a lower headline return, the active portfolio left more money in the pot. Why? Because in this instance, the return pattern mattered. Active strategies helped smooth the journey, reducing the impact of market dips during withdrawal periods. We saw the same pattern in higher risk portfolios over a similar period. Passive beat active on paper, but active finished with more capital intact after income was taken out. However, the eagle-eyed amongst you might well have noticed that I've cherry-picked a specific period of time to demonstrate a point. And of course, this might not always be the case. So the point of this data is really just to highlight that investing often gets more complicated during the decumulation phase. It's not as simple as just looking at total return data or whether one method is always better than the other. This is simply because performance tables only tell one story. Real-world investing, where you're drawing income and managing risk, can tell another. Indeed, for many people, a blended approach often makes sense. So if you're trying to work out which side of the fence you're on, you probably just need to be open to having a foot in each camp. And if you find it all a bit too complicated, do just speak to a financial advisor or investment manager who can help. Because remember, your money really does matter.